Welcome. This is TJ from TJ True, and I'm here to talk to you about the tips, tools, and strategies to creating your generational wealth and how you sustain and grow it. And I want to talk to you about the impending doom of this next market crash. Is this clickbait? You tell me. I'm just going to give you some facts and we're going to talk about this. So, interest rates are as low as they've ever been. Like, that's a fact. You can go ahead and look that up. And it sounds great, but I want you to think about this. And we've had super low rates since Obama came in, and that's been like 12 years. When Trump came in, they raised a little bit, but they are back down again. And we are at stunningly low interest rates. The average APR for a new car is anywhere between 3% to almost 14%, depending on what your credit score is. And that is a little bit higher for used cars, which is between 4% and 21%. So let's say that if you buy a car today and you have about mid-range credit, you're getting a used car with a floating or variable interest rate, which is rare for car loans. But let's say it's floating or variable, and your interest rate is about starts off at 13%, and the car is a $20,000 used car. Um, at 13% for 5 years, your payments would be $455, and in 5 years after you paid the car off, you would have spent $27,303.69. If your interest rate is 17%, you would have been paying $497 a month, and your total payoff for the cost would have been $29,823.09. If your interest rate is 25% for a 5 year loan on a used car that was only valued at $20,000 when you bought it, your payments every month would be $587, and your payoff amount would be $35,221.59, which is $15,000 more than what you initially agreed to pay on the car. Now, when I say fixed versus floating or variable interest rate, your fixed interest rate, if you have a fixed rate, that means that the entire time that you're paying off that car, your interest rate is never going to go above or below the interest rate that you started at. And if you have a variable rate, that means it goes up and down with the economy. Now, that that's that's neither here nor there. Let's talk about houses. Okay, so let's say that you are getting a loan to buy a $250,000 house, 30 years at a variable interest rate, which is sometimes very common. If your interest rate, which average right now 3%, that means your monthly payments would be a little over $1,000, um, and your total payoff amount on a $250,000 house would be $379,443.63. 5% interest rate, your monthly payments would be $1,300 more than that, but less than 1,400. It'd be $1,342, and your total payment amount would be 483,000 and some change. 7% interest rate, your payments would be $1,600, and your total payment amount would be almost $600,000 on a $250,000 house. Let's talk about if you can reasonably afford to go from $1,000 payment to a $1,300 or a $1,600 payment per month with what you are bringing in income right now. And for a lot of people, when they go in, they're talking about they use the maximum. You know what I mean? They're like, well, I can only afford this amount of money per month. You know what I mean? So and if you can't do that, let's say if the percentage is a 7%, um, the APR is 7%, and you still can only afford $1,000 payment, that means that you're not getting a $250,000 house. You know what I mean? That means that the house you're going to get is well below that. And it doesn't matter if you're buying or renting because someone has to make up for that rise in mortgage payments. And if you're renting, that's pretty much going to be you because the person who's renting to you is not going to take that loss. You're renting from them so that they can actually continue to pay their mortgage payments. Um, of course, they're going to increase your rent. So then let's talk about how many millions of people lost their jobs during the pandemic, and it wasn't even considered. It's not even a real market crash. we're still in the bubble right now. Like we are in um, the bubble where our economy has been staying up and profitable. Like yeah, a lot of people lost their jobs and a lot of companies went under, but in the grand scheme of things, we're still in that bubble. And I want you to also think about the fact that minimum wage is about to go up. Most of the minimum wage workers are in the service industry, the one that was hit hardest by the pandemic. So naturally, with these industries not doing so good and having to pay like extra money to their employees, and I wouldn't say extra money, what are they going to do though? Like fire more people? Like, of course. And that's not to say that $15 an hour is too much, because in my opinion, the minimum wage should be at least $25 an hour. And but that's a different video for an entirely different day. So, on top of all the millions of jobs already lost during the pandemic and businesses suffering because of it, which means they won't be able to fully rehire, add to that the 1.5 million or more of additional firings because that's going to take place because of the wage hike. Then add to that the ever increasing cost of living and the fact that historically low interest rates is not sustainable. We're looking at something really ugly coming. They're going to have to raise the interest rates. They're going to have to. But if you have little or no income, who's going to be able to afford the prices on the things that you're going to need to buy? So what happens? We've been printing money, right? It's estimated that between 20 and 40% of all money printed ever in America was printed in 2020. 20 to 40% of all money printed ever in America was printed last year. All money ever. And you can't keep printing money. That's the reason why we have like the certain issues that we have. That they did that in a lot of other countries, especially in Africa, where they have $100 trillion bill in Zimbabwe, and that bill is worth roughly 40 cents of American money. That's $100 trillion bill. And I say all of that to say this: the market is going to crash. It is inevitable. But it doesn't mean that it has to break you. Just remember the popular and relevant phrase cream. Cash rules everything around me. Rent if you can instead of buying a house until the bubble pops. Then buy when people are desperate because they thought they were going to have a 3% interest rate forever and now they can't afford their payments. Owner financing is probably going to get you a steal of a deal. Some experts say invest in precious metals and to sell some of your real estate holdings in order to stay cash positive. I'm just going to say this: cash, 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 and start thinking about what you can do now to protect yourself and to pivot when it comes because it's coming. Thank you.